Now we're looking at USDJPY, the trade taken on the 11th. Yeah, so let's look at the overall trend of the market because we have to start with the overall trend. Yes, we have to make use of multi-time frame analysis before we enter the market because the overall direction of the market will be what we use for our uh, trades, whatever the trend is. So if we're in an uptrend or a downtrend, we have to use different time frames to make sure that we know exactly what trend we are using, right? So this right here, we can see that a series of red candle, the market has been tanking to the downside. On the 4-hour time frame, the market is equally in a downtrend, right? So um, this is the trend, right? And then we move to the 1-hour time frame, and it's the same direction. We can see that the market is selling to the downside. So I plotted out my resistance and support zone. So I'll mark that out again. So this is a valid support zone because the market rejected from this point on several occasions. This is a equally a valid support area. This is a valid resistance zone. Supports turned resistance. Here we have a range that formed the supports, a very tight range that contains a resistance and a support, right? So the market was basically more of sales than buys. Like you see majority red candles and you even see green candles on the 1-hour time frame. So now we're looking at to take this trade at this point. You can see I marked out my zone. There was a red folder news on USDJPY on the 11th, and uh, we already got our direction that the market was going to continue to the downside based on the news. So all we needed to do was wait for our trade confirmation, and we let's go to the 30 minutes time frame, right? So on the 30-minute time frame, we can see a demand area, a demand reaction from this point here. Price is going all the way to the downside, but we can see demand. The supply pressure push price back to the downside. We can see there's demand in this area, but the demand didn't hold. Demand rallied all the way to the upside to join this higher demand at this higher price point. But price didn't hold. We can see that it went all the way up, reacted from this zone that acts as a equally a support and resistance zone, and then sent back to the downside. So price created a demand here, but the selling pressure dominated the buying pressure, and we're looking to see lower prices, right? So stop loss right above the wicks, and our take profit was at a previous support zone, a previous support zone where we were able to see demand. So on the higher time frame, we can see that. So on the 4-hour, we can see where price created demand with this engulfing candle. So on the 1 hour now, so we can come closer and see it. When we go all the way to the left, we can see how price created a demand, this inverted hammer candle pushing price to the upside and then created an engulfing candle here. So the demand is at the tip of this bullish variation candle at the end of its wick. So that is where we put our take profits. So move back to the 30 minutes, the price. Our price went all the way straight down into our take profits. So that was the trade. So it's what I say all the time, supply and demand zones. Marking out our resistance and support zones, and then identifying the supply and demand zones within that area, making use of candlestick confirmations to take our entry, making sure that the overall trend of the market is being respected as long as a particular trend is identified more than once on different time frames. For example, you see a downtrend on the daily time frame, you see a downtrend on the 4 hour, you see a downtrend on the 1 hour. Already we know that this is the overall market structure. So we have to follow that. You can't be looking for buys when the market is telling you that it is selling to the downside, because the institutions have a designated price points where they are pushing the market to. And every opposing pressure is just temporary. So if the market is selling, every opposing buying pressure is only temporary. And those are the points that create a structure for us to find our entries. So whenever the demand pushes price up and the market buys to a particular price point and starts rejecting back to the downside, that is the most reasonable place to take our entries. Why? Because we have the least amount of drawdown. We can easily enter the trade and start running in profits much sooner than just entering the market when the market is rallying to the downside without knowing where it's going to reject or react from. So those demand zones buying to the upside in a down trending market condition is what now gives us validation that okay, we can enter the market when this demand pressure is being exhausted, and then supply pressure is now dominating the market to continue pushing the market back to the downside. So that was how we were able to take this trade on USDJPY, and it was a very clean trade with a 1 to 3.28 risk to reward. It was a very valid trade. Yes. So we'll move on to the next one. So you can rewatch this video and take notes. Take notes of the important features and important parts that can be valuable to you that you can use, backtest it, practice it, and there's no limit to how much better you can get as long as you put in enough practice backtesting and live testing as well.